Current Corporation is authorized to issue 30,000 shares of $50 par value, 10% preferred stock, and 150,000 shares of $3 par value common stock. On January 1st, 2013, the ledger contained the following stockholders' equity balances. During 2013, we have a number of transactions that occurred. We need to journalize the transactions and the closing entry for net income, post the entries to the general ledger, and then prepare a stockholders' equity section. On February 1st, issued 2,000 shares of preferred stock for land, having a fair market value of $135,000. The fixed asset account, land, is increased by a debit of $135,000. Preferred stock is increased by a credit of 2,000 shares times the $50 par value, or $100,000, and paid-in capital in excess of par, preferred stock, is credited for the difference, $35,000. On March 1st, issued 1,000 shares of preferred stock for cash at $70 a share. So the asset cash is increased by a debit of $70,000, 1,000 shares times 70. Preferred stock is increased by a credit of $50 a share times 1,000 shares, $50,000, and paid-in capital in excess of par preferred stock is credited for the difference, $20,000. On July 1st, issued 16,000 shares of common stock for cash at $10 a share. So the asset cash is increased by a debit of $160,000. Common stock is increased by a credit of 16,000 shares times the par value of $3, or $48,000, and paid-in capital in excess of par common stock is increased by a credit of $112,000. On September 1st, issued 400 shares of preferred stock for patent. The asking price for the patent was $35,000. The market value for the preferred stock was $70, and the patent was indeterminable. So we used, to value the patent, the market value of the preferred stock. $70 times 400 shares is $28,000. So we debit patent for $28,000 and credit preferred stock 400 shares times 50, or $20,000, and paid-in capital in excess of par preferred stock is increased by a credit of $8,000. On December 1st, issued 8,000 shares of common stock at $8 per share. The asset cash is increased by a debit of 8,000 shares times $8, $64,000. Common stock is credited for 8,000 shares times $3 par value, $24,000, and paid-in capital in excess of par common stock is credited for the difference, $40,000. On December 31st, net income for the year was $260,000. No dividends were declared, so the income summary is debited for $260,000, and retained earnings is increased by a credit of $260,000. After all the journal entries are posted to the general ledger, we have an ending balance of $1,170,000 in preferred stock. We have an ending balance of $282,000 in common stock and we have an ending balance of $148,000 in paid-in capital in excess of par preferred stock. In paid-in capital in excess of par common stock, we have an ending balance of $852,000, and retained earnings, we have an ending balance of $560,000. Next, we will look at the stockholders' equity section of the balance sheet. In capital stock, we have 10% preferred stock, $50 par value, 30,000 shares authorized, 23,400 shares issued and outstanding, for a balance of $1,170,000. Common stock, $3 par value, 150,000 shares authorized, 94,000 shares issued and outstanding, balance of $282,000. So we have total capital stock $1,452,000. We have additional paid-in capital in excess of par preferred $148,000. Additional paid-in capital in excess of par common stock $852,000. So we have total additional paid-in capital of $1 million. Total paid-in capital $2,452,000. We add retained earnings of $560,000, and we have total stockholders' equity of $3,012,000.